Wealth Grower YouTube channel. My name is Axel Mayhofer and I'm going to be your host for today's episode. And I had to find a little bit of a quiet corner here. We have a lot of wind in the area today, but I hope you can still get the audio and everything comes across well. So today I was thinking I should talk to you a little bit about what are different ways and different kinds of levels of investing that you have from your position as the investor in this whole world of real estate investing, or when you're applying our strategy of out-of-state turnkey real estate investing. And it is a little bit related. How did I get triggered to actually have this episode today and talk about this topic? Is because in the media, last year we went through this whole election cycle, and that was one thing, but in the media, we are also constantly being reminded in subtle ways and sometimes in very direct ways how divided all kinds of things have come, and we are led to believe that we somehow need to make choices and we need to be on one side or the other, or we need to choose left and right, up and down, black and white, all these kind of things. And so when a certain topic or a certain type of conversation is being triggered and is being held over and over and over again, sometimes what happens to me is that I'm asking myself, how does that actually apply to what we are doing? Or does it apply, or is it even relevant? And fundamentally, I would say no, it doesn't, because we really make no difference wherever you are in life, where you're coming from, what your background is, your income, your financial situation, all those kind of things really don't influence in a way how we engage with you, how we help you, how we mentor you, the programs we do for you, or any of that kind of stuff. But I found one area where it's actually relevant and where I could imagine that you might actually not be completely clear or understanding why does it even exist and what does it do for you. And that is the separation. And you may have heard in the last few years, especially in the last 15 months, oftentimes talk about the 1% and the haves and the have-nots and that kind of stuff. And I wouldn't really like to label it that way, but there are some official terms, and one of them is what's called the regular investor and the accredited or qualified investor. And that is kind of a pretty clear delineation. And I wanted to take a little bit of time today, on the one hand, to address this. Why are these two groups? What are they? How do they come together? What's the thinking behind it? And so fundamentally, we all start out as regular investors, as regular people that have some sort of regular income, and we have the freedom to decide what to do with our income, with our money, whatever we have available to use for our investments. So the starting line is basically the same for everyone. Now, on the other hand, I'm sure you would agree that there are different kinds of investments, some being more risky, some being less risky. And what we typically get to see as regular investors are the kind of what I would call, in a sense, public investments, right? You can go on the stock market and find all the names of the different stocks that are there, and you can directly invest either through a broker, or you can go and get an online account at like Ameritrade or E-Trade or any one of those platforms, Rooftop or Roofstock or whatever it's called, and do your individual investments. Or you can work with a financial advisor and invest in a mutual fund. Or if you are an employee, you might have a 401k plan or some kind of retirement tax preferred and tax exempt plan. And what often happens is companies actually do arrangements with like Fidelity or Vanguard or any one of those big mutual fund companies, and you can invest that way. Now, there are some more sophisticated things, at a certain level of investment, when you're putting in a certain amount of money, you can also do options trading, meaning like you're buying an option to buy stocks on the stock market. Other investments, like the ones that we are always promoting, are real estate investments. So you can do residential real estate like we suggest with our strategy, but you probably know there's other real estate, there's commercial real estate, there are apartment complexes, there are storage units you can invest in, trailer parks you can invest in, all kinds of things in real estate that you can invest in. And all of it is publicly available. There is a brochure or the description, or you go on Zillow and any of those kind of things, and it shows you what's available, what the price is. You can do your own due diligence and your research, and you can invest. So that's kind of like the publicly available market. Now, besides that, there are other investments that also exist, and most of the time, not always, and it's not really a requirement, but most of the time, these other investments that exist have either more risk or less control or some sort of an attribute that isn't typically applicable in the public market or in the market that you have easy access to. And that's where this separation between regular investor and accredited or qualified investor comes in. So fundamentally, I'm sometimes find it pretty helpful when somebody makes nice infographics. So I'm just going to read to you what are the things, what makes somebody an accredited investor. And so you need to either have a net worth of $1 million or more. And net worth is calculated by taking all the things you own except your own property. And that is a very important distinction because especially in the last few years, people may be living in a location where the value of properties has increased tremendously, and you may say, okay, my property is $300,000, $500,000, $600,000, but that value of the property that you own and occupy yourself is not part of that amount of money, of that basically net worth. The net worth would be any kind of investment properties or stocks that you own, or equipment in companies that you own, or companies for that matter themselves can be evaluated, and you can actually find out how much the value of a company is. So all these kind of assets have a certain valuation, and if that valuation altogether is more than $1 million, then you qualify as an accredited investor. Now, there are two other ways how you can also qualify. If you are an individual, you're not married, you don't have a family, then you can also become accredited if you have more than $200,000 in income for 2 years in a row. So most people would say the last 2 years, but it could be last year and this year if you can actually prove that it's going to be $200,000 or more. The same kind of applies. There is a limit or a number when you are a member of a family. So for couples, when you're filing your taxes together, then the number is $300,000 at least 2 years in a row or more. You can have it 5, 6, 10 years in a row. But so 200,000 as an individual, 300,000 as a couple, or $1 million in assets that you have, except for your own principal residence. And so that gives you the status of accredited investor. And what is now available in a relatively smooth way, I just recently went through this process myself for one of the investments I wanted to do. They required to prove that I'm an accredited or qualified investor. You can go online, and law firms who are actually specializing in this financial accreditation have set up online portals. You can go on there, you can basically create a profile, and then you provide all the proof that you have. Like in my case, I provided the proof of all the different investment properties that we own and some of the stocks and some of the other investments that we have, to show that we have the required minimum in assets to qualify. And then when you go through that process and you have provided all the proof, then they send back a certificate that says we certify based on the evidence provided to us that this person, in this case Axel, is an accredited investor. Now, the interesting question then becomes, okay, why do we even do this? Why is it even relevant? What is it good for? And what I wanted to bring, and I brought my trusty document here as a reference. I mentioned earlier that for most of us, when we first start out, we are all regular investors and we have access to all the regular investments, all the stuff that's publicly available. But there are other investments that are either not publicly available, that are either more risky, or that are less regulated. And those are only made available to accredited investors. And here's the reasoning behind it. Before this whole notion of accredited investors came along, it was always clear that when you were willing to take on more risk or do stuff that are unusual or kind of creative investment things and so forth, that you would fundamentally understand that the higher risk also means that you could lose your money. But we are also, at least here in the United States, a very litigious crowd, community. People are very quick to file lawsuits or find a lawyer to file a suit on their behalf if they feel that something was done wrong, that they were somehow mistreated or somehow something wasn't right. So what led to this separation of regular investor and accredited investor is basically the fact that when people sued, they used the argument to say, yes, I put money into this investment because I thought it would be a good investment. And yes, it's true that I got a whole bunch of paperwork, but I didn't understand half of the stuff that was in the paperwork. It's kind of like the same thing like the small print in most things these days, where they don't even give you a choice to say, do you accept or reject? You either say, I accept the small print, or you can't have access to the platform or access to the app or whatever. And in investments, it's similar. You get pages and pages and pages of small print. And these pages exist more or less for the purpose of saying, we want to inform you about the associated risks that come with your investment. But people successfully sued and said, okay, I'm working a regular job, I'm not a financial expert, and so forth, and therefore I shouldn't be held liable for the success or failure of these investments. And naturally, as you can imagine, this always comes up when something goes wrong, right? So that basically people said, I was promised I would make 15% return on investment every year, and here we are 3 years in and I never got that money. Or I was promised that this is a safe investment and it would grow massively, and now it's all gone because I invested with somebody who was basically a thief. And I should be made whole, I want my money back. Those kind of cases. So the government basically said, okay, how can we adjust for this kind of situation that we don't have constantly lawsuits that claim that somebody didn't know what they were really signing in the contract? And that's where this aspect of accredited investor comes in, because like everything, it has two sides of the coin. For one, you need to qualify and actually become an accredited investor to be eligible for these higher risk and higher reward investments. And the notion is that you basically, in a sense, acknowledging by going through the certification process that two things are true. Number one, the investments that you are actually doing, you full well know that the money could be lost. So you acknowledge that there is a higher risk and that you can afford to make these investments. And the reason that you can afford it is because you have been accredited and you have either $1 million or more in assets, or you have a substantial income year after year, right? So if you were to lose your money, you're not suddenly becoming, moneyless and homeless and stuff like that. The other thing is the assumption that an accredited investor who makes this kind of money and is exposing this money and this investment to the risk is the awareness that you have about the risk. So you can no longer say, okay, well, I'm an accredited investor, but I have no idea what the risk is. That wouldn't fly. No court would accept that as a lawsuit. Now, that makes it important that you actually pay more attention. If you are an accredited investor or become an accredited investor, pay more attention to the details when you actually decide to make an investment. Now, I always say you want to spend the same amount of diligence and attention to every detail that you can in any investment, but especially if you do an investment that can only be made by accredited investors, you want to be extra vigilant and extra cautious. So that is basically the risk and the knowing that the money can get lost and the knowing that not everybody can do this investment. On the flip side of that same coin is the question, what are the things that I can do as an accredited investor that I couldn't do if I were a regular investor? And that's where my little list comes in. So the things that you can do is you can, for example, invest in what's called private placements, where a group of people knowing about the risk each gives some money in a private placement. You can have a private fund, so not the publicly available funds, but a private fund. You can do private investments, one person to another person or groups amongst each other. You can do venture capital funds, right? You may have heard, for example, that there are regularly announcements about somebody that did some research and came up with a good idea and worked in a laboratory, but now they need to take it into the commercial space. And as you can imagine, to build something on a commercial scale, like Elon Musk always says, making a prototype is easy. Mass producing it is really, really, really hard, because you need the machines and you need to be able to do consistently high quality, all of that kind of stuff. And that costs money. So venture capital money means people who have money, like accredited investors, are putting money in because they believe that invention can become a home run. That invention can make a lot of money, and I'm putting some money in for, let's say, a 5, 10, 20% stake in the company. And if everything works well, you get 100 times or 1,000 times your investment out. But if this thing never becomes a product for whatever reason, then your money is lost. So that would be venture capital funds, venture debt funds, angel investments. It's the same thing on a little bit smaller scale. You can actually create hedge funds or invest in hedge funds. And you can also participate in certain kinds of real estate crowdfunding. So when you go on crowdfunding websites for real estate, you will find some of them are actually only allowing accredited and qualified investors, and some also, very few, also allow regular investors. The problem with the ones that allow regular investors is that they run the risk that something goes wrong and even one of the hundreds or thousands of those investors sues, and then the lawsuit might cost more than the benefits. So it's a little bit of a captive audience, so to speak, a limited number of people, and everybody who goes into this knows we are taking higher risks. We are only investing the amount of money that we are capable of losing without losing our livelihood. And that's why we are certified, and we can prove that we are certified as accredited investors. So the last point in the context of Ideal Wealth Grower that I want to make is in the context of our time freedom point that I'm always advocating and advertising that we want to reach as out-of-state turnkey real estate investors. Because if you really think about it, let's say your time freedom point number, meaning the point in the future where your passive income out of your real estate investment exceeds your expenses, would be $5,000. And you say, I need 20 properties because I'm expecting on average to get $250 out of every property. So that would be 250 times 20 is $5,000 a month in passive income. When you have 20 properties, you will also definitely have more than $1 million in assets, and they won't be your own house. They will all be investment properties. For most people, it happens somewhere between the 12th and the 15th property, unless you buy properties that are like $150, $200, $250, $300,000 each. But you can do the math yourself. So there is a little bit of a motivational aspect in this reaching for the time freedom point, going down this journey and building this residential real estate portfolio, because besides all the other benefits and really being able to live your passion and do with your time what you want when you reach that time freedom point, also comes the benefit of being an accredited investor, which opens up opportunities, especially on the lending side, that regular investors don't have. So I look at it basically, and I hope you would look at it that way as well, as basically a little bit of a reward that you get for diligently going on the journey and building your passive income portfolio and ultimately reaching your time freedom point. So that's the deal about accredited and qualified investors versus regular investors, why it can be motivating to do this and go after this, how you get certified, and how it relates to what we recommend to actually become an ideal wealth grower, reaching your time freedom point and become successful that way and independent. So I hope that was informative for you. If you're not already a subscriber, I would like to ask you to subscribe. If you like the video, give it a thumbs up, and please share it with your network so more and more people can get access to this particular video and the many other videos we have on our channel. So with that being said, be well, stay safe, and I see you in the next video.